The Dow Jones Industrial Average. You've likely heard it mentioned in financial news, but what exactly is it? Simply put, the Dow is like a report card for 30 of the most significant and influential publicly traded companies in the United States. Think of names you know: Apple, Microsoft, Coca-Cola, McDonald's. These aren't just any companies, they are leaders within their respective industries. Back in the late 1800s, Charles Dow and Edward Jones created this index to understand how the industrial part of the American economy was performing. While the focus has broadened beyond just industrial companies over time, the core idea remains: track a select group of major players to get a sense of the overall health of the stock market. So how does it work? It's not as simple as just adding up the prices of these 30 stocks. Instead, a divisor is used. This divisor is adjusted over time to account for events like stock splits and dividends, ensuring the index provides a consistent and comparable measure over the long term. While the exact calculation is complex, the key takeaway is that the Dow's movement reflects the average price performance of these 30 key stocks. Imagine it this way: if many of these large companies are doing well and their stock prices increase, the Dow Jones will likely rise, suggesting a positive trend in the market. Conversely, if many of these major players see their stock prices decrease, the Dow will probably fall, indicating a potential downturn. Why should you care about the Dow? Well, it acts as a general indicator of the U.S. economy's health. While it only looks at 30 companies, it's a widely followed benchmark. When you hear on the news that the Dow is up or the Dow is down, it offers a quick snapshot of how investors feel about the prospects of these major companies, and by extension, the broader economy. It can influence investor confidence, business decisions, and even how consumers feel. A rising Dow can signal optimism and potential growth, while a falling Dow might raise concerns about economic challenges. It's important to remember that the Dow isn't the only way to measure the stock market. Other significant indexes like the S&P 500 and the Nasdaq Composite track a much larger number of companies. However, the Dow's long history and its focus on these influential blue-chip stocks make it a significant and closely watched indicator. So there you have it, the Dow Jones in simple terms. It's a way to track the average performance of 30 major U.S. companies and get a sense of the overall direction of the stock market. Hopefully this explanation has been helpful. If you found this video informative, please give it a thumbs up and subscribe for more straightforward explanations of the financial world. Feel free to leave any questions in the comments below.